Hello, good morning or good afternoon, everyone. Thank you for coming to our halftime report for 2024. Delighted that you're here today, and hopefully we'll get to share some important information for you as we look at the markets going forward, and also where we've come through up until today. I want to draw your attention to these disclosures. Please take a few moments to review these and let me know if you have any questions or ping us. But as you know, these are typically required. Today, I'm going to focus on four key areas. We're going to first review the first half real quickly, and then secondly, take a look at potential market forces in the second half outlook. And then from there, we're going to ask, where are we now? What are we supposed to be looking at and focusing on? And finally, taking a look at what's ahead and what we think might be in store for us in the second half. So let's begin by reviewing how the stock market performed during the first half of 2024. Here's a snapshot of the S&P 500 index from January 1st, 2024 to May 1st. The S&P 500 notched a pretty solid gain, supported by generally positive first quarter corporate earnings reports and news reports about how artificial intelligence was helping drive productivity gains. The first half was marked by three overriding themes. One clearly was the AI enthusiasm, inflation fears, and Fed signals. As monthly inflation reports gave mixed signals, the market looked for guidance from the Fed, which was balancing between how it planned to manage inflation while acknowledging economic activity may lead to a change in short-term interest rates. During the first half, you may have heard the phrase Goldilocks economy, which suggests activity was moving forward at a not too hot, but not too cold pace. We use a chart of the S&P 500 composite index frequently in this presentation because it's generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of any particular investments. Past performance obviously doesn't guarantee any future results. And we also note that you can't actually invest in the indexed as an index. It's always through some kind of market vehicle. So we talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, various media outlets compile some Wall Street analyst predictions for the year ahead. And this image shows several projections shared at the end of 2023. How do those predictions compare to reality so far? Well, the S&P 500 closed at 5,277 on May 31st, 2024. The S&P 500 closed at 4,770 on December 31st, 2023. Through the first 5 months of 2024, stock prices have exceeded what our six leading Wall Street analysts had predicted. Even the most optimistic forecasts in the table represented an increase of just under 7% for 2024. The outlook reflected expectations that the economy would likely run out of steam or inflation would reignite, which may have resulted in higher short-term interest rates. Now, I just want to point out that we're not at the end of 2024, so there are some months left. So, it doesn't mean that these people might not be spot on, but clearly some things are going to have to change in the second half to alter the momentum that we've been experiencing up through the year this far. So in the following slides, we're going to discuss a few factors that may impact stocks in the second half. We're going to start here to create some context about where the economy may go in the second half of the year. Let's start by taking a look back a few years ago so you can get a better perspective on how quickly outlooks can change. We picked January 2022 as a reference point since it represents a moment in which the pandemic was now mostly in the rearview mirror. As the indicators suggested then, the outlook for the coming 3 to 6 months was exceptionally optimistic. The Federal Reserve's monetary policy remained accommodative, and interest rates had not begun their climb from their historical lows. On virtually every important economic indicator, from inflation and monetary policy to credit demand, availability to energy costs, it was flashing positive. Only three indicators were neutral or cautionary: the political environment, equity market valuations, and geopolitical risk. There were no negative indicators. However, these conditions would soon reverse. And looking back, we all know how 2022 was. It was perhaps on an aggregate bond and stock level, one of the worst years in history as far as how the total investable market performed. And so by January 2024, after we had gone through 2022 and had a bit of a recovery in 2023, just 24 months later, the outlook for the coming 3 to 6 months was significantly changed and much more guarded than optimistic. First, despite interest rate hikes to historical levels during the first half of 2023, by the second half of the year, the Fed had started to slow down the pace of that tightening. As you can see, 17 of the indicators were neutral at the start of the year, while 3 slipped to red: equity market valuations, international economic outlook, and geopolitical risk. So now let's look at where we are today. As of June 2024, can you see the difference? Now, roughly 1/3 of economic and financial indicators are positive, with only 2 negative, which is valuation outlook and geopolitical risk. First quarter's earnings season helped boost the corporate profit outlook, and notably, inflation, labor, and credit availability among the indicators now in the green. Consumer spending and consumer sentiment, along with housing, one of the most stubborn areas of inflation, have also swung to positive outlooks. And another thing I might add to this is that you may have noticed, like in the financial press and things like that, where the higher for longer and stubborn inflation used to be quite the talking points every day on the financial press. We've slipped away from that, and now we're potentially looking at are things too tight? Is unemployment going to get worse? And these are the big debates: unemployment and how that impacts spending and the economy. So I just pointing this out because we have noticed a shift. Everybody seems convinced the Fed is going to cut, and we're going to talk a little bit more about that today. So a little bit on to corporate earnings. This chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the two lines have generally moved in the same direction over the past decade because the stock market is a discounting mechanism reflecting what investors believe the economy will look like, say, 6 to 9 months into the future. Stock prices can at times change more quickly than actual earnings growth would actually show. At the highest level, the Federal Reserve has 3 functions. 1, to provide an effective payment system to the U.S., and 2, to regulate banking operations, and 3, to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As the Fed works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with inflation in the 2% range. The charts we're looking at depict consumer inflation on a year-over-year basis and a month-over-month basis. As you can see in the chart to the left, there was an uptick in the year-over-year inflation numbers in the first quarter, which is one reason why the Fed is being cautious about changing course with interest rates. That first quarter increase was followed by a modest decline in April, but the consumer price index still remains above the Fed's target 2% inflation rate. So we expect that the Fed's decision on monetary policy to continue to influence financial markets And particularly today, the Fed actually announced that it was holding rates steady. So I guess we're still in the higher for longer phase. But Powell did say today that cuts were on the table for the September meeting. There's going to be a recess in August, but the next one in September. So stock markets today were actually moving in line nicely with that sort of scenario where rate cuts uh, uh, might help boost earnings with lower cost of capital, et cetera, but also that there were some positive earnings reports out there as well. And so the inflation scenario, even though it's still a little bit above the Fed's target, is looking benign. And I will say another thing that when the Fed is trying to slow down the economy, the economy is like a aircraft carrier in the ocean. It doesn't just turn on a dime. Even if you cut the engines, it still takes time for that thing to slow down. So the Fed is trying to anticipate where they're going to be in employment and inflation, and not just completely data dependent. But as of today, it's still higher for longer. Taking a quick look at the labor market continues to demonstrate its resilience despite questions about the economy. This vitality has provided an important support to the market, since having a job obviously is foundational to consumer spending, which helps drive economic growth. And in fact, consumer spending is, roughly 70% of the economy. This strength may be illustrated by two labor market measures: the unemployment rate and current job openings. The unemployment rate continues to remain at historically low levels thanks to robust hiring. Even in the face of this robust hiring, the percentage of companies unable to fill open positions remains quite elevated, despite it actually having fallen off somewhat over the past 12 months. With these two historical measures, the labor market, for all intents and purposes, looks pretty healthy right now. Looking at the consumer sentiment, the University of Michigan's Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for a significant amount of GDP, as I mentioned earlier. As the chart indicates, consumer confidence has continued its recovery from its historic lows in June 2022. The chart shows that sentiment has been on a general upswing since then. So it seems like the mood is quite positive and will continue to reinforce the general direction of the economy. So on to artificial intelligence. Artificial intelligence has obviously been a market buzzword for the past couple of years. And to keep investors updated, Standard & Poor's 500 companies are providing updates as part of the quarterly conference call with investors. And as you can see in this chart, in the Q4 2023, AI was mentioned on earnings calls 179 times, as investors want to hear from companies about their plans to use this newest technology. All right, so now let's examine where we are today and then dive into a little bit about the future. Let's take a moment to consider the variables that may weigh heaviest on market performance. We believe the factors that led to the first half's market performance remain critical to how the market may behave in the second half. The first factor, obviously, is inflation. It's on everybody's mind. While accelerating inflation is no longer a concern of the market, some investors, and perhaps more importantly, the Federal Reserve, worry that inflation may prove to be sticky at the elevated levels. If inflation remains where it is presently, then it may influence where ultimately the Fed decides to move regarding interest rates. And so that's kind of big, and we need to see some progress on that stickier inflation that we talked about earlier. Recession, I guess, is still a possibility as the economy has showed signs of slowing, though there's a lot of debate about where we are on that. People from my research, are starting to push potential inflation recessions back out past 2025 at this point, as we seem to have come into firmly into a soft landing scenario. But I think, the jury is still kind of out on that. However, the U.S. economy, like I said, is resilient, raising hopes for a soft landing that some by now are declaring a fait accompli. I'm not sure we're there yet, but we have that. It's going to be an important thing to monitor going forward. Now, if artificial intelligence continues to be a driver of stock market gains, which it looks like it is, and it looks like even though yesterday Microsoft got pummeled because of its poor AI performance, NVIDIA came out with a bullish earnings call today, and that's in part what's driving the general market indices, because as we'll talk later, it's a pretty important factor. So the issue behind AI, apart from the hype, is that supposedly it's going to bring greater efficiencies. It's gonna bring more focused capital spending and continued positive consumer sentiment around that as companies explore these AI opportunities. I think there's a potential for overhype and overinvestment, but that's something that we have to monitor, and it also argues for a more cost approach, how much concentration you take in that area, even though we do think long-term AI is going to be a significant factor in improved margins going forward. Obviously, it's very difficult to predict the future, but we're hoping that kind of talking about these perspectives will help you understand better what may be on the horizon. So finally, let's look at a potential forecast for the second half of the year. Economic growth may be an integral variable in how the markets perform in the coming quarters. In fact, I would argue that that's really the main driver is growth and margins, if you really want to kind of sum it up to a couple of things. To gain better insight into how economists think the economy will perform, we take a look at May 2024 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. Now let's look specifically at the consensus forecast for three key economic factors that may drive much of the market's perception about the state of the economy: GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view as of May 24 is that gross domestic product growth is expected to be between 1.5% and 2.4% in 2025. Again, we're talking about 2025. Meanwhile, these professionals are projecting that the unemployment rate remains low at somewhere between 3.7% and 4.2% in 2025. And their inflation expectations, as measured by the core PCE, we call it personal consumption expenditures, to be between 2 and 2.4%. Now, I mentioned earlier the Fed really wants it around 2, but that's a pretty comfortable level. Now, remember, forecasts are based on a lot of different assumptions and subject to revisions over time, and we will see revisions. That's one thing for sure. Also, financial, economic, political, and regulatory issues may cause the actual results to differ from expectations expressed in this forecast as well. Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. This chart shows the bottom-up EPS and the price of the S&P 500. Now, a word of caution that this type of analysis shouldn't be seen as a perfect predictor of a stock price performance. In this chart, notice how stock prices have been trending flat to higher, while corporate earnings are more mixed. When evaluating this chart, it's important to remember that the stock market is considered a discounting mechanism, which means that it's always looking forward. Put another way, the stock market's price today represents all of the available information about current and future events. So when you look at this variation here and you look at, the earnings, the bottom-up earnings seem to be kind of flatlining a little bit, but we see that the index performance is going up. So what does that mean? It could be one of two things. Either the market as a discounting mechanism is wrong. If this stays flat, then valuations have gone way up, or maybe valuations have gone up because they're anticipating lower discounting rates through Fed cuts, or it means that maybe that we're actually going to see an acceleration of earnings per share going forward. So I just wanted to put that there into perspective. Most people agree that this discounting I've been talking about, the activity is really looking at 6 to 9 months, maybe 12 months out into the future. So, like I said, are we going to see a turnaround in earnings? It looks like it. Looks like market forecasters are anticipating higher earnings growth rate going forward. So, looking at projected 2025 earnings growth, considering the importance of corporate earnings to stock valuations, the big question, obviously, for investors is what can we expect in the future? On an earlier image, it was clear that stock prices have trended higher in the first half of 2024, despite the mixed earnings report. Now, market analysts expect all 11 market sectors to show earnings growth overall will slow up a bit in 2025. But if you take a look at the chart, you'll notice that the earnings for 6 out of the 11 industry sectors of the S&P 500 are expected to grow compared with today. You can see in the gray is as of 31st of March and today. So earnings for those, so for a number of those sectors, earnings projections are increasing, right? So it's the rate of change, they're increasing. And in particular, you see that with tech and healthcare and industrials and a few others. So near the center of this chart is the overall earnings growth projection for the S&P 500 companies expected to be 14.2%. And obviously some sectors are also expected to lag while the other sectors are carrying that forward. Now I want to take this moment to pause and take a look at valuations and market concentration, since we've been talking a lot about the S&P 500. I borrowed a few charts over the next few slides. You're going to see some charts from Franklin Templeton's ClearBridge investment team. They have a call with professional investors like myself once every few months to update on their analysts. And I pulled these from there because I thought they were relevant to our discussion today. This shows the weight of the top 10 stocks in the S&P 500. So the top 10 stocks in the overall 500 stocks, right? So the top 10, you can see that that this is at an all-time high at 37.5% weight of those top 10 stocks. And this suggests, what the suggesting is that there's some concentration, obviously, that as the weight goes up in those top 10, there's some concentration. And it's the highest in recent history. So while this dynamic could potentially persist going forward, where we could see, this is NVIDIA, Microsoft, the Mag 7, the tech stocks are driving this concentration of return, but there is a reversion to the mean, and things can happen that will change the expectations, or at least cause market participants to more closely scrutinize those top 10 stocks. So looking at the earnings expectations, this is the advantage of the Mag 7, right? Those are the tech stocks we've been talking about. And looking at the earnings expectations for the Mag 7 helps us understand the risks of such concentration. So in 2023, you can see over the left here, the Mag 7 posted incredible earnings growth relative to the S&P 500 and relative to the Russell 2000. But notice the forward expectations. So there's still market strategists are still expecting that the Mag 7 still have a robust 2024, while the rest of the market is turning around, right? Turning around its earnings growth. But look at as you go out to 2025. So you see this start to converge. And so the question kind of begs itself, like, how should valuations of the Mag 7 or the top 10 behave if we're starting to see earnings convergence? So another way to look at how these largest 10 stocks are impacting valuations, you can see here that this chart shows the PE multiples for the 10 largest cap stocks in the S&P 500 versus the remaining 490. And as you can see, by stripping out the largest 10, market valuations for the rest of the market don't seem that high. And this illustrates how important diversification comes, especially when you're trying to buy for value, i.e., buy low, sell high. So where is the greatest amount of value? And in fact, over the last month, I don't have a chart for it here, but over the last month, value stocks, in other words, lower priced relative to earnings stocks have outperformed tech over the last month. And sometimes we see long stretches of periods where this happens. So, when we talk about buying stocks at reasonable valuations, you have to kind of question where you're coming in, because I know there's a lot of hype around, NVIDIA as an AI proxy and Microsoft and Google and others, but we have to be very careful about how we allocate our exposure to equities, given that we can see sometimes very powerful, very significant rotations in stock market leadership. Now, if you look at an equal weight, this is another way to look at valuations. The S&P, there's actually an equal weight where they take the S&P 500 and they equally weight each stock in that, right? So at 0.2%, right? There's 500 stocks, roughly 0.2 gives you when you equally weight them, and you look at their PE on an equally weighted basis, the market actually isn't that highly valued when you just look at it on that simplified way. And this also illustrates it's really just a handful that really are distorting the market. The overall market seems to be relatively priced within its range of historical average. So if we see a period where the rest of the 490, as we indicated on the previous slide, start to catch up on earnings growth and are priced much more reasonably, that's something that could ignite a rotation into value that could last for a certain period of time. And so you don't want to have exposure to that. Okay, now let's look ahead a little bit for short-term rates. You can see here that this is the schedule going forward. And guess what? This is July 31st. And at the end of that meeting, they announced today that they would not be raising rates. But that is a big question. There's an old saying says, "Don't fight the Fed." You want to be where the Fed is going, and the rate cuts are definitely in favor of stock market gains and also overall improved economy because of lower costs of capital. I don't want to dwell on this too much. I've already explained what happened today. I would say that the consensus is that rate cuts will happen in September, and that's mainly because the view on inflation is pretty benign at this point. So I'm going to talk a little bit about this inflation and how sticky it is. So progress on inflation can sometimes be difficult. One aspect of inflation, in particular focus for the Fed, is, as well as obviously market analysts and economists, is what's the sticky inflation. Sticky inflation refers to components of the consumer price index that have historically exhibited a greater rigidity or a stickiness with respect to price changes. In this chart, 12-month sticky inflation is the orange line, while the 12-month CPI, which we hear a lot of, is the gray line. Sticky inflation includes many service-based categories, including medical services, education, and personal care services, as well as most of the housing categories. Fed Chair Powell has often referred to stickiness in his service-related inflation as one of the reasons for remaining vigilant in the Fed's fight to lower inflation. And in fact, he's invoked that same thing today to let's keep it higher for longer, at least for one more cycle here, or one more meeting. So as you can see in the chart, while the Atlanta's Fed's measure of sticky inflation has been stubborn, it definitely has moderated over the past year or so. So obviously the Fed has to monitor this and feel comfortable that it's time to cut. Like I said before, the U.S. economy is a gigantic uh, uh, aircraft carrier in the ocean. And even if you cut, it doesn't mean that the direction you're going to go in is immediately going to change. So that's an important factor to consider. Real quickly on bond dynamics, we've been focusing a lot on the equity markets. Um, we obviously always want bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, existing prices go down, right? And yields go up when the Fed is changing interest rates. So in 2022, we saw the yields follow up the Fed's short-term rates, the Fed funds rate, and we saw bond prices obviously go down, just like you see in this chart. Those yields went up, bond prices went down, or people were selling bonds to make the yields in line with the Fed. We still have, the remnants of that move in the market today. But the question is, what happens when the Fed cuts rates? So when the Fed cuts rates, we're likely to see some increases in prices and bond movements, and this is generally a good thing because if it's cutting, even if it's to forestall a recession within your portfolio, your bond prices are going up, so raising the value of your portfolio and potentially offsetting any volatility on the equity side. So that's why having exposure in the bond market is so important. So tuning out headline noise while managing your financials is not always easy. We see it all the time, and I'm not going to talk about the election too much. People are going to ask about the election all the time. The only thing I'm going to forestall that conversation today because I don't want to go too much into it. But when you're looking at the election, you're looking really at policies, not at characters or personas. You're looking at policies. And so policies are what affect the economy, but those policies, generally speaking, take a long time to implement. So these are not necessarily things that are going to have immediate impacts. There are obviously favorable sectors that might favor from one party winning over the other, but just bear that in mind. A lot of that stuff is just noise. And even though the press and the financial press are going to talk a lot about it, it really the administrative policy, even from one party to the next, doesn't change that much over time. So we've gone over a lot today, but I'd like to conclude with a longer term perspective on the financial markets. Having this perspective, I think, is key when pursuing financial goals we've set for ourselves. After a very disappointing 2022, and I've mentioned that to you earlier, frustrations were very, very high. But since late 2023, stock prices have been trending generally higher. This chart shows an analysis of bull and bear markets during the period from May 1970 to March 2024. Here we see the average bull market lasts nearly 76 months. On the other hand, the average bear market has run a little over 15 months. As we can see above, the rewards of a growing and innovative economy often go to investors with the discipline to remain invested over the long term. Here's another ClearBridge slide I wanted to share with you. It's basically the same slide, but it's showing actually it in the S&P 500 in a chart. It's kind of easier to see. And you can see in the dark gray is the secular bear markets, and the dark blue is the secular bull markets. And we've entered one in 2010, and generally they're about 20 years in length. So we're a little over halfway through your average secular bull market. And you can see large consecutive returns here, 50 to 70. The cumulative returns 451, even greater from 80 to 2000. That was 1,200, and here we are, 389. So we're not even close to the other long-term secular returns. And I point this out because even though stock prices are at all-time highs, if we are in a secular bull market, where earnings and particularly corporate margins and things like that are trending upwards. Even though you feel like, oh, I'm investing at the highs, the reality is there might be more return or upside available to you. As you can see here, the 12 months following an all-time high, stocks have historically been up 8.3% on average, 70% of the time. So you have a statistically very high probability of seeing higher returns going forward. And that's not because it's just some magic of the market. It's because secularly, we're talking about a secular economic trend. And right now, what we're seeing is, especially with the potential for increased productivity due to AI, this new technology could really enhance productivity. And so I think there's potentially a lot more upside to go. Now, having talked about AI, I also want to talk about investing fads. This chart illustrates the exuberance of these investing fads that happens from time to time. These faddish themes have occurred fairly frequently since 1970, when gold rallied higher only to trend lower. These trends can develop in broad markets like Japan and Asia in the 80s and 90s, or they can form in certain asset sectors such as internet or biotech companies. The current enthusiasm for artificial intelligence, or AI, as we call it, started in late 2022 and continues to grow this day. Now, what I want to emphasize is the importance of following a long-term investment strategy and not getting sidetracked by fads. In this case, sidetrack meaning over-concentrating in artificial intelligence. We think it's a very good investment theme, but you also don't want to over-concentrate. Does AI offer the potential of meaningful capital growth for investors in the years ahead? Well, it very well may, and it probably will. But there are ways to incorporate AI into an investment strategy that takes into account the consideration of your goals, time horizon, risk tolerance, as well as market rotation and things like that. So, you got to keep in mind that some of the investing fads you're looking at can be considered sectors of the stock market, right? And in fact, there are thematic themes and ETFs and things like that you can invest to take advantage of it. Now, they do have a narrower focus, and because of their narrow focus, a sector investing strategy tends to be more volatile than an investment strategy that is diversified across many sectors and companies. So here at APS, we try to blend those two. We try to focus on that to give a little bit of tilt towards sectors where we think have a significant amount of adoption and a significant amount of growth. But you have to be careful of just over concentrating in that. And so we remain dedicated broadly to a broad investment allocation across the equity markets and across the bond markets, so that we don't get too caught up in a highly volatile investment strategy. Finally, the market timing discussion. I know most of you are thoroughly versed in our belief that market timing is not a good strategy. And we don't practice market timing at APS for any of our portfolios. Generally, it just doesn't work over longer periods of time. And as a simple analysis, you can look at this chart. You can see in the blue is a buy and hold strategy since 1945, and the gray is buying 12 months after a market trough and selling 12 months before the peak, which you might think is maybe the best way. Actually, it's probably the way most investors would do it. They would wait till after the trough. Once they're convinced that the market has started to recover, they're going to buy, and they're going to sell after the peak, because they're convinced that now that the market run is over and they're just going to lose money, so they're going to sell. And this is the problem with market timing. And so you can see the difference in cumulative return over time, right, of $100 since 1945. You're just not going to. It's really, really difficult to meet and to beat a buy and hold strategy. So we're focused on here is actually allocating your portfolio and giving you a portfolio that's respective of your particular risk profile, your objectives, and your time horizon. And everybody's different, and a lot of portfolios are customized to meet those demands. But in none of those is a market timing strategy. So I bring this chart to your attention simply because at the end of the day, there's a cost to market timing, and this represents what that cost is. And so as we go forward, and either if you get jubilant about the market, enthusiastic, or you get concerned or worried, let's talk about those fears and concerns and hopes in context of a broader investment strategy and not just trying to get in and out of the market. All right. So I've gone through a lot of information here. I'm sure there's probably some lingering questions. So you could always email us questions later. Okay, one from Larry. So perhaps inflation isn't as big concern going forward, but having heard that real estate prices have been up, are REITs a good hedge against inflation? Well, real estate historically has been seen as a hedge because with the theory that real estate is a limited commodity, and commodity as a limited commodity will go up with inflation. I would certainly say that real estate tends to go in line with inflation, but it's also subject to supply demand factors as well. That's why you've seen in the past that California have real estate that's far exceeded at times the general growth of the economy, and less so now here in California, but other areas where populations and demographics are moving, where demand is increasing and supply is not keeping up. You're seeing real estate prices far exceed inflation. In fact, when we look at inflation, that's one of those areas that is really a big question mark. Now, with the CPE looks at owner's equivalent rent in real estate, and what we're seeing is that's kind of the owner's equivalent rent lags because lease contracts and things like that last a full year, so it takes time for new lease information to kind of feed in. And it seems like according to Zillow, they have an index, leasing price increases have more or less flattened out. And so from an inflation perspective, we won't see real estate impacting that. But I don't see real estate directly as a hedge on inflation, and nor any commodity for that matter, not even gold. We're not gold bugs, though I know can be a benefit to owning gold. But inflation, the best way to beat inflation, actually in the long run, where you can exceed inflation, is actually equities. That's been proven true. So if you're trying to beat inflation, the best place to be is in equity as a hedge. People have gone to gold and other commodities because, but that's really more of a monetary supply issue, how that works, and that's a longer discussion. But I don't know if I think REITs can be really great dividend pairs. They're really great investments for cash flow, especially if you need cash flow. And right now, or at least especially a few months ago, they were particularly good because they had been beaten down because of the interest rate environment and the commercial real estate market environment. And so you had some pretty good yields. I think over time it's gonna be good right now, but not necessarily because it's an inflation hedge, but because REITs tend to be really interest rate sensitive. And if rates get cut, you're gonna see REITs go up, I think. So in that sense, they kind of behave a little bit more like bonds. I'm going to sign off. Please email us at advisors@advancedportfolios.com with any of your questions. Go to our website. We'll have a replay of this video, and we have other resources there for you at www.advancedportfolios.com. Thank you all for your participation.